Well, to absolutely nobody's surprise, the stock market is choosing violence yet again today. The NASDAQ itself is down basically 2.4%. And chances are, if you are an individual stock picker like myself, your portfolio is down by much more than this 2.4%. It's been a very painful time period. There's been a lack of buyers and there's been an abundance of sellers. People that just can't wait to exit their portfolios and get back on the sidelines because all of a sudden, just in the last couple of weeks, the economy looks extremely grim. And we're going to have a stock market crash all of a sudden. In fact, we just got new sentiment data this morning that shows 60.6% of investors are now bearish about the stock market's future for the next 6 months, which is the 7th highest reading of all time. The 6 readings that have come in previously higher than today's reading all occurred on dates that were at or around local stock market bottoms. So it actually turns out when most people become bearish, we should become bullish. And the opposite can be said too. When most people become bullish, we should become bearish. Think back to 2021. But based on today's data, and based on the fact that most people have become bearish, just in the snap of a fingers, we should actually be bullish today. And I do believe there's relief coming to the markets, and I'll discuss that at the end of this video. But if you're new here or returning and not yet subscribed, please subscribe down below. I love seeing all new faces pop into the YouTube channel. We are quickly approaching 40,000 subscribers. The growth has been incredible. I can't thank you guys enough for that. But to dive into this video, let's start with Jeremy from Financial Education's tweet today. He quoted a tweet from Unusual Whales that reported that Trump says there will be 20% tariffs placed on China. And he said, "Thank you, Mr. President Trump. We so appreciate it. If we put tariffs on everything so prices go up and everyone loses their jobs, we should have stocks go up a lot. Yay." And I want to be clear. I'm a supporter of Jeremy. I have a lot of respect for him. You will never see me diss Jeremy. But I could not fundamentally disagree with the premise of this tweet more. I think this is exactly what the markets are getting wrong. It's no secret that the roots of the stock market's concerns right now are around tariffs and the potential inflationary consequences of those tariffs during a time period where we already have inflation that's stuck above the Fed's 2.0% target and is already somewhat re-accelerating. Now, what does Jeremy and basically the entire stock market have wrong right now? It's that we can actually go back and look at the data and see that in Trump 1.0, during the first round of tariff increases, inflation actually downtrended. It was below the Fed's 2.0% target and went lower despite tariffs being doubled in size, as you can see based on this chart. Contrary to popular belief, and we have data that backs this up, tariffs do not tax the American consumer. Why is that? It's because of our economic system it's designed in a way to encourage competition. Consumers in America hate paying higher prices. We love our cheap prices, and just because of competition, let's say 2 corporations out there provide the same good or service, and one of those corporations chooses to pass on a tariff to the consumer and raise prices for the consumer, and the other corporation chooses to eat that tariff in their own profit margin and keep the price for the consumer the same, well, that corporation is going to get all of the business that the other corporation previously had because American consumers like our cheap goods, and it's extremely hard for American corporations to pass on costs to consumers because of this. So people have it so wrong when they say the consumer is who ends up getting taxed. No, it's actually corporations that end up getting taxed. And how do they eat the tariff? They eat it in their profit margin. Right now, though, corporate profit margins are at all-time highs, and corporate profit margins have been uptrending since basically 1990. As software companies have become larger and larger, and our largest companies in the United States of America are no longer these industrial giants with super low profit margins. So now more than ever, companies have the ability to eat these costs in their profit margins because they're so elevated right now, which means that our economy isn't going to feel as much pain as most people anticipate. Now, it's not to say the stock market won't fall. As we can see in 2018 and 2019, after those tariffs were implemented, the stock market did enter a bear market, down 20%. But it's because of corporate profit margins that ended up taking a hit in the S&P 500. It's because the earnings outlooks took a one-time downgrade because of those tariffs. And yeah, the stock market has been priced to perfection. People looked at Walmart, their earnings report, and saw that Walmart stock was down by 10% following their earnings report. And automatically that led investors to assume that the consumer is in terrible shape because Walmart stock went down 10%. But if you actually look at Walmart's earnings call and their earnings report, yeah, they guided low, but historically Walmart has been a company that issues low guidance. And if you listen to their language, they're simply issuing lower guidance in preparation for potential dark clouds that might loom over the economy, rather than dark clouds that they're seeing loom over the economy right now. And that's a big difference. That is a huge difference. Now, I want to make another thing very clear. When the markets get something wrong, I'm actually all for it, because it opens the door of opportunity for somebody like myself. And all that matters to me is ensuring I'm not the one creating the opportunity for other investors. I want to be the one taking advantage of the opportunity that other investors create for me. And that's exactly what I think is happening in the stock market right now. People are so confused about tariffs, and they have tariffs so wrong. And I'm not saying that tariffs are going to have a 0% impact on consumers, but whatever impact it does have on consumer prices is going to be minimal, and it's going to be a one-time hit. It's not going to be a structural problem. It's not going to be recurring inflation that laps itself year after year after year after year. It's going to be a one-time hit to inflation, whatever impact tariffs actually do end up having on consumer prices. It's not a structural problem. You know what is a structural problem? You know where true inflation does come from? It comes from a Federal Reserve that prints too much money to accommodate fiscal irresponsibility. And you know what tariffs are aimed at doing? Tariffs are aimed at fixing that fiscal irresponsibility and actually making our government become more fiscally responsible. So in the end, tariffs should actually decrease the systemic risk of embedded inflation. And you want to know another thing about it? A trade deficit is actually a drag on GDP growth. It's a drag on economic growth of our country. Imports take away from GDP, exports add to GDP. And a trade deficit means your imports outweigh your exports. And in the United States of America, it outweighs exports. Imports outweigh exports by a lot, which is a drag on the economy. If you all of a sudden start to bring that back into balance, it's no longer a drag on GDP or economic growth, and it's actually a tailwind to economic growth in our country. And that's exclusively focusing on the trade imbalance. That's not even talking about how employment would benefit, how tax receipts would benefit, and how household incomes would benefit in the United States of America from more domestic production. All tariffs do is they change the economic math between importing goods and services from overseas and domestically producing or sourcing those goods and services. If it changes that economic math to making domestic production more attractive, that also benefits the economy. And when Jeremy says everybody's going to lose their jobs because of tariffs, first of all, that premise is defeated if my thesis is correct and the data is historically accurate. But let's just entertain this and say that tariffs do cause consumer prices to increase by a lot. Well, let's think about it. We've had rampant inflation just recently. Did that rampant inflation cause people to lose their jobs? No, unemployment is actually at a historical low. Why is that? Well, it's because of, I believe, it's the shift that took place during the pandemic years of job workers actually going to jobs that they enjoy and they want to be at, and they succeed in their jobs. And corporations don't want to get rid of those workers. And I've yet to even touch on the fact that interest rates are now at a place where the Federal Reserve has the ability to cut them if they have to in order to avoid a recession. We think back to prior years and, all of the recessionary fears out there, specifically in 2022, that ended up being a no-show recession. It's the most anticipated recession of all time, and it never ended up happening. And that's despite interest rates that went up from 0% to 5.5%. That's despite all of the inflation. That's despite those recessionary fears. And that's despite the mini banking crisis we had. And I think it was 2023 where Silicon Valley Bank failed and a few other regional banks failed. That was prevented from morphing into an economy-wide credit crunch and thus a recession. So why now? Why now are we convinced that inflation, interest rates, tariffs, whatever it is going to cause a recession if it hasn't caused a recession over the last 4 years? That's a very tough argument for me to understand. Because if anything recessionary does pop up, it's not like interest rates are at 0% still, where if we cut them, it'd have to go negative, which that'd be a problem. Interest rates are back to 5% and at a place where they can be cut if we need them to be cut, and we can stimulate the economy if it needs stimulus. But outside of Walmart, which kind of triggered the fears around the consumer from investors right now, we've had weaker than expected retail sales. But there's historical seasonality at play here that I don't think the markets understand. And there were some weather-related events that happened in January that decreased overall hours worked from consumers, which if consumers work less hours and earn less money, yeah, they're not going to spend as much in the economy. Now, if this does become a trend, that's when I do get a little bit concerned. But even then, the Federal Reserve can cut interest rates to stimulate the economy and stimulate, spending and investment in the economy. This really isn't a problem, but we can look at the Red Book data, which shows us sales-weighted growth in year-over-year same-store sales of large U.S. general merchandise retailers representing about 9,000 stores. Sure, okay, yeah, I mean, the actual numbers came in 0.1% lower than last month. Boo-hoo, we're at 6.2% same-store growth. 6.2% same-store growth year over year. And we think that that's recessionary. 6% same-store sales growth over the last 12 months. You think that's recessionary? I mean, if you think that's recessionary, I don't know what to tell you. I mean, that's strong year-over-year growth during a time period where actually goods prices, so things you would buy at a store, actually fell. That's very strong same-store sales growth. And Redbook sales data has been very accurate with anticipating the consumer. We can even look at things like initial unemployment claims, which remain very low. Again, though, you have the Department of Government Efficiency. Sure, they're firing government employees, and you actually have departments of the government that are firing employees in anticipation of the Department of Government Efficiency doing it for them. So yeah, you're going to have government workers that get laid off. It's already happening. That might boost, unemployment, weaken the labor market a little bit. But chances are when those workers re-enter the economy, re-enter the jobs market in the private sector, they're actually going to be respected more in the jobs hiring process. They're probably going to be paid more. They're probably going to be able to spend more because they are paid more. You can kind of see where this is going. And I forgot to mention this, but for all of the talk and hype about AI and the productivity enhancements it's going to deliver over the coming decade, if the market is concerned about the S&P 500's profit margin falling temporarily, what are we doing here? Because AI, if you are a believer in AI, you firmly will believe that any impact of profit margins that tariffs have will be offset by AI in future years. So again, it doesn't match up. Stock market, what do you want? But let's talk about this. When do I think relief is going to come for this stock market sell-off? I actually think tomorrow. We're going to have a green day tomorrow. That's going to be the first day of relief, in my personal opinion. Don't have a crystal ball. Could be wrong. There's my caveat. But the reason I think this is because the markets are worried about inflation. Right or wrong? I think they're wrong to worry about, tariffs causing further inflation, but that's what the markets are worried about right now. And the markets have to become less worried about it if we want the markets to go higher. So how does that happen? Well, inflation data has to come in at or below expectations. It has to start cooling off here. It can't keep increasing. It can't stay in this uptrend. It can't stay in this reacceleration like PPI and CPI have done. The good news is tomorrow we get PCED inflation data for the month of January. In December, this reading was 2.6% year over year. The Cleveland Fed has an inflation nowcasting model that anticipates January's data coming in at 2.5%, which would be a reduction from December's 2.6%, and it would show further disinflation, which, if that's the case, could lessen the market's concerns about stagflation, could lessen the market's concerns about recession if rate cuts can come back on the table from inflation being lower and trending lower. So the cure to all of this is cooler inflation data, which I think we're going to get not only in the PCE data, tomorrow, but in future CPI and PPI readings as well. Now, when there's pain in the stock market, like there is today, investors can start to believe that it's the companies they own that are at fault, that the stocks they own are terrible stocks that have terrible management teams, and they're just terrible investments, so they need to sell out of those stocks. That is not the case. In reality, it changes all the time, but in reality, most of the time, management teams have less control over their stock price than the masses think. The stock market is generally driven by overall emotions of the entire stock market and of the entire, thought process of where the economy is headed. If investors are bearish on the overall economy, the stock market's going to fall, and I don't care how strong of a company it is that you're invested in, their stock price is also going to fall more times than not. That's just the reality. So don't get faked out of your positions here. Don't think that you've made a mistake investing in companies that you believe in just because they've fallen more than the market has. That's just it's part of the game. That's what happens in the stock market. And if you're an individual stock picker and you're chasing that 10x return, you have to be okay with losing 20, 30, 40% on your initial investment pretty quickly after your first initial buys. But you should actually get excited about that because it's an opportunity to get more ownership of a company you love at an even cheaper valuation. But most people can't see through the smoke. Most people get faked out of their positions. Most people don't have the patience they need. And in reality, that's what makes them miss the 10x opportunity 100% of the time, even if they're invested in the right stock. So don't let that be you. And don't hear what I'm not saying. You have to do your research. You have to do your due diligence. In a bear market, you have to be even more stringent with the research that you do on companies. But this is where, life-changing money can be made in time periods like this, when the markets are getting something wrong and they're selling off companies at cheap valuations and making those valuations become even more cheap or attractive. And I'm taking advantage of that. And I'm not sitting here telling you what to do with your money. This channel has always been just me explaining my thought process and my analysis of things. That doesn't mean you have to listen to me. That doesn't mean I'm going to be correct. I could be wrong about all of this. This could be the start of the next bear market. I don't know, but regardless, I'm going to invest in great opportunities. I'm going to invest in companies that I think are at very low valuations right now. And it's always during time periods like this where I wish I had more capital to invest, but man, I'm doing my best. I'm trying to eliminate all unneeded expenses and increase my income and just keep plowing money into this market, into those opportunities that I see. And that's going to be the game plan for me moving forward. I think this bull market is going to continue into the 2030s. And if you're a believer in AI, that should probably be your thesis too. That doesn't mean we're going to be immune to bear markets or immune to corrections in the stock market, but it means all in all, any dips that we do get are going to continue to be great buying opportunities moving forward. We have hundreds of years of history in the stock market that proves every single tip we get ends up being a great buying opportunity. But most people don't get to take advantage of those opportunities because they're a part of the masses that get things wrong and that are driven by emotions. Keep emotions out of your business decisions. Think logically. I know it's hard when your stock is falling 5% every single day. You start to think you're getting something wrong or you're missing something. But in reality, most of the time you're not. And it's just the broad market. It's just the broad thought process around the economy's outlook. With that, I hope you guys enjoyed this video. Let me know if there's holes in my thesis. I'm always open to discussion. Leave me a comment. I love seeing all the faces on the YouTube channel. So with that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground, your chin up. Peace out.